Then we also just recently spun out a debt focused fund called Cask Strength. And so that one doesn't do any equity. It's purely debt. So there's some specialized asset based lending that happens in beverage alcohol. And that's kind of what got us into the debt side of things. And so early on, we were doing barrel lending and, in fact, still do kind of similar things now. That initiative has grown into what Cash Strength is, which is not just barrel lending. It's more venture debt. We do things like debt restructuring and debt for expansion. Oftentimes, there's a real estate play there, a rick house expansion, or something analogous to like a shopping center where a distillery or a brewery is going in, thinking on the real estate end of things. Debt often can play well there. And then for the producers, there's things like lines of credit or things that are specifically geared towards production runs or PO financing or something that's a little more repeatable than going PO by PO. Really what we do, kind of bumping up a level, is we work with smaller and medium-sized businesses to leverage something that's flexible. What we're seeing on the equity side first is hesitancy from investors. There's been really a myriad of press that's come out over the last couple of years talking about the negative value cycles in bourbon as an example, or that there's headwinds in alcohol as a whole, or certain segments of our population aren't drinking the way that they would or could or should, maybe, depending on who you are. What we are seeing is there's a lot of interest in venture debt. And so that on our side is what we're seeing trend wise in terms of where investors are choosing to put their money. Now, the caveat points to those overarching trends is that on the debt side, you're going to see bank type performance. You're not getting that 10, 20 times multiple on your investment that you can get on the equity side, depending on what round it is that you're participating in.
Got it.